Hey guys, Toby Mathis here. As a real estate investor, it's important to stay up to date on the latest tax strategies to make sure you're taking advantage of all the deductions and credits available to you. Keeping your taxes as low as possible is essential for success in this business. There's an old adage, by the way. If you're paying taxes and you're a real estate investor, you don't own enough real estate. In this video, I'm going to share with you a number of key tax strategies that every real estate investor should know about. Let's go over the first one. And this one is almost always missed because I have people come in and they say, I can't afford any investment real estate. I can't buy a rental property. Yet they have tens of thousands, if not hundreds of thousands of dollars sitting in a retirement plan, either a 401k from a previous employer or an IRA, and they have no idea that you can actually invest those funds into real estate. Yes, you can. If you go to TD Ameritrade or Schwab or one of the big brokerage houses, Fidelity, Morgan Stanley, whatever, and say, hey, I want to invest in a piece of real estate. I saw a great rental property. It cash flows. This is an excellent investment. They're going to say not through our plan. It's because their plan documents don't allow you to direct the investments unless it's on their platform. And guess what they don't have? They don't have independent real estate on their platforms. So what you have to do is set up an IRA that is called self-directed. You can absolutely, these are really simple. There's lots of companies that do it. I like IRA Club. Dennis Blitz over there does a great job. But you go ahead and you roll your plan into your own IRA that's self-directed, or better yet, if you have a business, set up a 401k with Anderson and you could be your own trustee on it, and then you could go out and actually buy rental real estate directly in your plan. And it's this one of those really cool areas where you won't pay tax on that plan or on that real estate ever until you start taking required minimum distribution sometime later when you're 74 now. Or if it's a Roth, you'll never pay tax on it. Other strategy, you have to keep good records of your income and expenses. And this is really, really important. A lot of people give it lip service, but just keep a track of what money's coming in from where and what your expenses are, because those expenses will offset that income. And you can absolutely, there's a ton of it, from real estate taxes to the management fees that you pay to repairs. Know the de minimis exception on for tangible real estate when you're fixing up that property, that there's different ways to treat it. And I'll share another one with you. There's something called a cost seg, which is going to really blow your mind. But all those expenses, driving around, looking at the properties, things that come out of your pocket on those properties, those are expenses. Make sure you're tracking them. And more importantly, make sure you're tracking which property it belongs to. If you do that, there's a good chance that you're going to offset your rents on those properties and get your tax pretty darn close to zero. The other thing you can do, and this is why a lot of folks get mad at the wealthy, they can use a 1031 exchange to defer your taxes on capital gains and on recapture on any on your depreciation that you take. And what does this mean in English? It means that I could buy property. Let's say I bought a real estate, piece of real estate, a little single family residence for $100,000. Years later, it grows to $300,000. So I sell it and I buy two more of $150,000 each. And then those go up to $300,000 and I buy four more. And again, I'm just dividing out my portfolio and growing my wealth, and I just keep buying more real estate. If you 1031 those transactions, in other words, when I sell that first property and I go through a qualified intermediary, I can reinvest that entire proceeds and pay zero tax on that sale. And you say, but wait a second, you sold it for $300,000, you only bought it for $100,000, and you had depreciation. Surely there must be some tax, and absolutely not. And then all you have to do, this sounds crass, but all you have to do someday is pass away, because then your basis is going to step up to the fair market value on the date of your passing, and guess what? You will not owe any tax. Your heirs will not owe any tax. The next area is claiming depreciation on your property, and let me explain how this works. So let's say that I buy a piece of land and I put a house on it. So here's my house. So this house goes on there. The house has a value. The house I get to write off over time. So I'm going to get to take depreciation on that house. The improvement value I'm going to be writing off over a period of years. And most practitioners go right to, hey, if it's residential, it's 27.5 years. If it's non-residential, it's 39 years. It's not that simple. When you walk into that single family house that you bought as a rental property, what you should be noticing is that there's a lot of other things inside that house. It's not just a box on a piece of land. I'm going to write off things like the carpeting. I'm going to write off things like cabinets. I'm going to write off the appliances over there. I'm going to go in the backyard and where we put in new trees and things like that, maybe a new deck. That's land improvement. That's 15-year property. Carpet's 5-year property. The appliances and the cabinets, things like that, 5 and 7-year. I can write them off much faster. Now, why do we do that? Because depreciation is a fancy way of saying take a deduction against your income. So if I have $20,000 a year coming in as income on a property, and I have $20,000 of expenses and depreciation, that's a deduction. Even though I receive $20,000, guess how much tax I pay? 0, because I have something that offsets, reduces the income, because I have this depreciation. Now, depreciation can be accelerated. Not only can I break it into its components, 5, 7, 15-year property and 27.5-year property. I can break the whole building down, but I could take anything that's 20 years or less and write off close to all of it. In some years, it's 100%. As we're sitting here today, it's 80% for 2023. But I could write off a significant chunk of those items all in 1 year and create what's called a passive loss carry forward. And if you're like most investors and you're a passive investor, you just carry that forward and it's going to offset future years' income. So if you have rents coming in year after year after year, there's a good chance you won't pay tax on your rents for 10 years. If you're one of those people out there that's a real estate investor and you're enticed by this and you say, gosh, this is perfect for me, get professional help so you can see exactly what it's going to do for you. Do not try to do everything yourself. And things like cost segregations, you're going to have to use a third party. And there are professionals in all aspects, everything from tax credits to cost segregation to 1031s to using a self-directed IRA, everything. There's professionals in all those areas to make sure that it's benefiting you. These strategies benefit you, the investor. So stay up to date on the latest tax laws by subscribing to this channel and make sure that you're taking advantage of every deduction in credit that's available to you so you can mitigate that tax burden and make sure that you're keeping more of your hard-earned money in your pocket.